Clay Patton on the Rural Radio Network. Let's catch up with the weekly commodity trade now with Darrell Holaday, Country Futures in Frankfort, Kansas. Darrell, coming in, a lot of inflationary data. Really seemed like it was the bigger market, the macro market, however you want to look at it, was kind of the leader here as they just continued to get inflationary data. What did that do to our commodity trade?
Well, that's good. Yeah, that really was, and I think most of the volatility was in the outside macro markets, or even in the metals and the energy. Grain side, probably one of the quieter weeks we've had. Now, that's relatively speaking. We all know what we've seen the last couple of years, but as a whole, I would call this a quieter week. Volume a little bit lighter. We started the week on the grain side with a move up. We went up against some key resistance, both fundamental and technical resistance we'll talk about. Well, generally we did it early. We pushed those March soybeans up to 15.55, and we saw the corn move up to 6.85, 6.87, and we just couldn't break through that area really. And once again, we've worked back. We worked lower off of that. Some of the we had rain in Argentina early in the week in the central southern areas. And really, as a whole, Argentina did pretty well with rain this week. It's weird. I think people have a difficulty. If you look at maps of the rain this week, for example, you'll see a significant amount of regions from 2 to 4 inches of rain, and you go, well, my goodness sakes, if we had 2 to 4 inches of rain in part of our critical month in July, we'd be set for a while. Well, it's Argentina. Soils are so much different, and they dry out a lot, and they've been dry, but they've had rain every week. So it's just a different climate, different soils, as I would stress. That's true of Brazil also. It's why they need so much more rain. There's not much fertility in that soil, and they generally need to have, they got to have timely moisture, and that generally means about every third day. And that's about what Brazil's had this year. With Argentina, has certainly not been that fortunate. But as a whole, we did see moisture. Now it's going to dry out till the middle of next week, and then we'll see another wet period late next week, and then on in the models late in the week certainly indicated the first week of March look awful wet. But once again, we don't know that's what's going to happen, but that's generally what things are playing out in the EU and the GFS models. We did see some support in the wheat market throughout the week. It generally held up on the brakes because of the support from the uncertainty of the Black Sea corridor and the things that were going to go on. The negotiations are going to start next week. Late in the month, I should say, and that we've got all this positioning, just like we had in November. You got Putin wanting things, you got Ukraine wanting things, and Putin indicating he doesn't want to approve it if it doesn't go. We don't make these changes for some of his issues that he's dealing with, specifically the ability to use other banks to clear the trades. But he really needs to sell wheat, so I still think in the end we'll see that market work its way. We'll see that agreement work its way to some type of extension. We did see the U.S. corn exports picking up this week, but the window's closing rather fast. We probably got 30 to 45 days in which we'll be able to. We've got a market that at least we can compete with the South Americans if they want the South American crop or corn offers if they want to buy it in the next 60 days. The problem is corn's bought normally about 60 days out, so in 45 to 60 days they'll be looking into the late May, June, July period, and that's when you'll see the Brazilian safrinha crop available, starting to get available, and of course the Argentine crop also at that point in time. The soybean window has closed, but it doesn't mean sales will go to zero, but we're not going to see those big sales. I think the big concern you'd have is how many sales that we have on the books to China right now will actually be canceled, moved to optional origin Brazil, because the Brazilian soybean offers for soybean oil are 15 cents below the U.S. price. The meal prices are $50 a ton cheaper, and soybean prices the 60 to 70 cents below U.S. prices. So, and they're going to get worse as the Brazilian basis kind of has basically imploded this week with big aggressive harvest pace. We've seen about a 50 to 60 cent break in those basis levels of the offerings. In other words, offerings is that much cheaper on a basis level out of Paranagua. But as a whole, that's the big story was generally the corridor issue, that the uncertainty of that, and the rain in Argentina, and also the harvest that we're going to see that we're seeing develop in Brazil. On the week, the March corn closed 678, unchanged on the week. New crop December corn closed at 596. It was also unchanged. March soybeans 1527, down 15, and the new crop November beans 1379 was actually up 9 on the week. The March Kansas City wheat closed at 906, down 3 on the week. July Kansas City closed at 880. 3 up a penny on the week. March crude oil down 338 on the week. It closed at 76.34. Most of that weakness late. Markets has a hard time up there near that $80 level, so pushes back towards the mid-70s. Once again, the lack of the oil inventories and the gasoline inventories on a weekly basis still higher than you'd anticipate, indicating fairly slow demand period. And once again, the outside forces, as you talked about, the inflation data that we got the producer price index out this week, that was certainly higher than anticipated. Again, sitting there at a 0.7% increase all month over month. Certainly way above where we need to be. Just concerned the Fed's going to come right back. It has to keep coming in and keep pressuring, pushing interest rates higher, and also it's got to start continue to liquidate their balance sheet. I don't really think anything's really changed with them until certainly if they're going to follow the data this week would indicate they got to still be aggressive fighting inflation, as they got a long way to go. On the cattle futures were higher. All the livestock were higher. Cash cattle up $1 on the week. We saw tops in the south at 162. In the north, we saw in that 161 to 162 area. Still, the feeder cattle market continues to struggle with the fact that feedlots in the north struggling with conditions, and it really has not got any better. And we've got a major system coming through next week that won't help the situation at all if it pans out. But once again, a lot of those cattle have to be discounted on the fed cattle side because of just carrying so much mud, bought in the meat and a lot cheaper. The yields are bad, the closeouts are poor, and once again, it may get worse next week. And of course, those whole situations kind of creates a weakness in the demand for feeder cattle. Those feedlots are certainly not wanting any more cattle. They have no interest in buying cattle, and so that's kind of positioned feeder cattle weaker to the south. And or you have to push all of them into one area, and we saw the weaker index total to some extent. We saw the feeders give up some ground to some extent, but both the products higher, beef and pork, really strong. Choice beef up over 280, and we saw the pork up over that $83 level. So we're seeing some good strength, but the issue is on the live hog or the lean hogs, as they continue to have such a big premium to the index, which is moving higher. It still even came out when we finished the week. We were still $10 higher than the most recent index that's just below 76. Fed cattle on the week, 163.57, up $2.30. The April contract up 70 at 164.65. March feeders 12 higher at 186.52, but the May feeders actually down 20 at 194.35. April hogs 85.27, up 195 on the week, and the June hogs 102.72, up 197.
And that's Darrell Holaday, Country Futures, Frankfort, Kansas. Find more anytime when you visit countryfutures.com. Do remember, trading futures and options involve risk of loss and may not be suitable for all investors. Do consider these risks before investing.